Over the last 12 months, Lumentum generated $2.11 billion in revenue and $251.60 million in net income. Earnings per share came in at $3.27. On the surface, that sounds solid. Gross profit was $781.40 million, with a gross margin of 37.12%. But here's where things get interesting. Operating income was just $20. $50 million translating into an operating margin of only 0.97%. So what does this mean for investors? It tells us that while the company is profitable at the bottom line, operating efficiency is tight. In fact, EBITDA was $267.70 million, but EBIT was only $20.50 million. That gap is important. The company's profit margin stands at 11.95%, yet operating profitability remains thin. Now, let's talk valuation, because this is where things get intense. The trailing PE ratio is 214.26. That's extremely high. Even the forward PE sits at 61.28. The price-to-sales ratio is 23.77, and price-to-book is 59.11. Investors are clearly paying a premium for this stock. However, the PEGI ratio is 0.61, which can suggest growth expectations are strong relative to valuation. But here's the flip side. Debt levels are elevated. Lumentum holds $1.16 billion in cash, but total debt stands at $3.32 billion. That leaves the company with a net cash position of negative $2.17 billion, or negative $30.36 per share. The debt-to-equity ratio is 3.92, and debt-to-EBITDA is 11.78. Even more concerning, interest coverage is just 0.89. That means earnings barely cover interest expenses. Liquidity also looks tight. The current ratio is 0.61, and the quick ratio is 0.41. Working capital is negative $1.48 billion. So yes, revenue and net income exist, but the balance sheet pressure is real. Now let's move to cash flow. Operating cash flow came in at $247 million. But capital expenditures were negative $276.50 million. That results in negative free cash flow of $29.50 million, or negative 0.41 per share. So, despite reported profits, free cash flow is slightly negative. Here's another layer. The stock has surged 866.77% in the last 52 weeks. Momentum is clearly strong. The 50-day moving average is 448.61, and the 200-day moving average is 227.70, showing a strong uptrend. However, the RSI is 73.72, which suggests the stock may be in overbought territory. Beta is 1.53, meaning volatility is higher than the broader market. Short interest is also notable. About 15.11% of shares outstanding are sold short, with 10.79 million shares shorted. That's not insignificant. It means a meaningful group of investors is betting against this rally. Days to cover stands at 2.06. Ownership structure is interesting too. Institutions own 113.03% of shares, while insiders hold just 0.74%. Shares outstanding have increased by 12.85% year over year, meaning dilution has occurred. The shareholder yield is negative 12.85%. Now let's look at efficiency and returns. Return on equity is strong at 29.27%, but return on invested capital is just 0.69%, and return on assets is 0.29%. The weighted average cost of capital is 11.89%. That means returns on invested capital are well below the company's cost of capital, something long-term investors should pay attention to. The Altman Z-score is 1.24. A score under 3 suggests increased bankruptcy risk. That doesn't mean bankruptcy is imminent, but it does signal financial stress risk. The Piotrowski F-score is 6, which indicates moderate financial health. And finally, what do analysts think? The average price target is $505.46, which is 27.89% lower than the current price. Despite that, the consensus rating is buy from 14 analysts. So what does all of this mean? On one hand, you have explosive price momentum, strong institutional ownership, positive net income, and a high return on equity. On the other hand, you see elevated valuation multiples, heavy debt, thin operating margins, negative free cash flow, liquidity pressure, and an Altman Z-score signaling higher risk. This is a stock that has already delivered massive gains. The big question now is, can fundamentals catch up to the price? For investors, this becomes a story of balancing growth expectations with financial risk. Momentum is powerful, but valuation and balance sheet strength always matter in the long run. As always, this is not financial advice. Do your own research, understand your risk tolerance, and look beyond just the stock price chart. Because when a stock runs up nearly 867% in a year, the next move matters even more.